Imagine waking up tomorrow to the news that a single quiet decision in a government office on the other side of the world has just multiplied your money 1,000-fold. This isn't just a daydream for lottery players. It's the palpable, breathless hope that drives thousands of investors to scrutinize every whisper and rumor surrounding two of the world's most talked about exotic currencies, the Iraqi Dinar and the Vietnamese Dong. Welcome, everyone, to what might be the most straightforward, no-hype, and deeply analytical comparison you will ever see on this topic. We are not here to sell you a pipe dream or to promise an imminent windfall. Our mission today is to dissect, compare, and understand the Iraqi Dinar and the Vietnamese Dong on a fundamental level, stripping away the layers of online speculation to look at the cold, hard realities of economics, geopolitics, and potential future trajectories leading into 2025 and beyond. This is a marathon, not a sprint, and to run it successfully, you need more than just hope. You need a map. Consider this video that map. So, if you are genuinely ready to move beyond the forum posts and the cryptic intel, and step into a world of factual analysis, I urge you to watch this entire video without distraction, because the conclusions we draw might just change how you view global currency markets forever. Let's begin our journey not with the currencies as they are today, but with the nations that give them life, starting with the heart of the ancient Mesopotamian civilization, Iraq. The story of the Iraqi dinar is inextricably woven into the modern history of the nation itself, a history marked by conflict, sanctions, and a desperate struggle for stability. To understand the dinar's potential, one must first appreciate the sheer scale of the catastrophe it has endured. The Iran-Iraq War in the 1980s, the first Gulf War in 1990–91, over a decade of devastating sanctions that crippled the economy and impoverished the population, the 2003 invasion and the subsequent years of sectarian violence and insurgency, and the more recent brutal war against the Islamic State, which saw significant territory, including major cities like Mosul, fall under terrorist control. This relentless sequence of tragedies has left deep scars on the country's infrastructure, its social fabric, and of course, its currency. The dinar, which was once a strong currency pegged to the British pound and even stronger than the US dollar at one point, went into a freefall. The currency we discuss today, the Iraqi dinar, exists in its current form largely as a consequence of the new currency notes issued by the Coalition Provisional Authority in 2003, replacing the Swiss-printed Swiss dinars of the north and the Saddam-era dinars of the south to create a unified, new Iraqi dinar. However, the economic foundation upon which this currency stands remains fragile, built upon a single dominant pillar, oil. Iraq possesses one of the world's largest proven oil reserves, a treasure trove of black gold that should, in a perfectly rational world, translate into immense wealth and a correspondingly strong currency. Yet, this very dependence has become a curse, a classic case of the resource curse, or Dutch disease, where a nation's economy becomes so hyper-specialized in a single commodity that it neglects all other sectors, such as agriculture, industry, and technology. The Iraqi government's budget is almost entirely funded by oil revenues, meaning the value of the dinar and the health of the national economy are perpetually at the mercy of global crude oil prices. When oil prices are high, Baghdad is flush with cash, able to pay for its massive public sector payroll and reconstruction projects. When they crash, as they did in 2014 and again in 2020, the government faces existential budget crises, struggling to pay salaries and fund basic services. This volatility creates a fundamental instability that is anathema to a strong, revaluing currency. Furthermore, the political landscape in Iraq is a labyrinth of competing factions, Shia, Sunni, and Kurdish, each with their own militias, political parties, and foreign backers, primarily Iran and the United States. Forming a government can take a year or more of intense, behind-the-scenes negotiations, and passing critical legislation, such as the long-stalled hydrocarbon law to properly manage the oil and gas sector, or the National Oil Company law, becomes nearly impossible. This political gridlock directly impedes economic progress and, by extension, any genuine, sustainable strengthening of the Iraqi dinar. The central bank, while making strides towards independence, often finds its monetary policy decisions influenced by political pressure to finance the government's deficit, which can lead to inflationary pressures. So, when you hear discussions of a dinar revaluation, or RV, you must contextualize it within this reality. A nation with phenomenal potential, yes, but one that is still grappling with the profound challenges of building stable, transparent, and effective institutions from the ground up after decades of destruction. The potential is not a myth, but the path to realizing it is far more complex and arduous than many online gurus would have you believe. Now, let's shift our gaze over 4,000 kilometers to the east, to the vibrant, bustling, and rapidly transforming landscape of Vietnam. If Iraq's story is one of potential hampered by persistent instability, then Vietnam's narrative is a masterclass in the systematic and relentless execution of economic potential. The Vietnamese Dong, or VND, operates in a completely different ecosystem, one defined not by a single resource but by a dizzying diversity of economic activity. To understand the Dong is to understand the philosophy of Doi Moi, the series of economic renovation reforms launched in 1986 that moved Vietnam from a centrally planned, impoverished, post-war nation to what it is today, a dynamic, manufacturing-driven, and export-oriented powerhouse. Where Iraq's economy is a one-trick pony, Vietnam's is a multi-headed dragon, breathing fire across sectors from textiles and footwear to electronics, machinery, and increasingly high-tech services. This is the first and most critical distinction between the two currencies. The Vietnamese Dong is the currency of a nation that has consciously and successfully integrated itself into the global supply chain. It is the China plus one strategy in action. As labor costs in China rose and geopolitical tensions prompted companies to diversify their manufacturing bases, Vietnam emerged as the prime beneficiary. Giants like Samsung, Intel, LG, and Foxconn have poured tens of billions of dollars into the country, building massive production facilities that have turned Vietnam into the second-largest exporter of smartphones in the world. This foreign direct investment, or FDI, is not just about building factories. It brings with it technology transfer, managerial expertise, and integration into global trade networks, creating a virtuous cycle of development that strengthens the entire economic foundation. This robust and diversified export engine provides a constant inflow of foreign currency, which supports the Dong and gives the State Bank of Vietnam, the country's central bank, a formidable war chest of foreign exchange reserves to manage the currency's value. However, this does not mean the Dong is a strong currency in the traditional sense. In fact, it has historically been subject to a controlled, gradual devaluation against the US dollar. The State Bank of Vietnam actively manages the Dong's value within a trading band, and it has pursued a policy of a slow, predictable depreciation for years. Why would a successful economy deliberately weaken its own currency? The answer lies in the very export model that drives its growth. A weaker Dong makes Vietnamese goods cheaper and more competitive on the global market, fueling the export machine that is the core of its economic strategy. So, for an investor looking at the Vietnamese Dong, the primary narrative is not one of a sudden dramatic revaluation, but rather one of stability, controlled management, and the long-term organic strengthening of the Vietnamese economy, which may, over many years, translate into a stronger currency. The government's focus is squarely on maintaining macroeconomic stability, controlling inflation, which has been kept in the low single digits in recent years, and ensuring the steady high GDP growth that has made Vietnam one of the fastest growing economies in the world. The risks for the Dong are different from those for the dinar. They include the potential for a global economic slowdown reducing demand for its exports, the challenges of an aging population in the coming decades, and the need to continuously move up the value chain to avoid the middle-income trap. Furthermore, while Vietnam is a one-party state, its political environment is remarkably stable and predictable, especially from an economic policy perspective. The Communist Party of Vietnam is unequivocally committed to economic growth and integration, as evidenced by a series of ambitious free trade agreements signed with the European Union, the UK, and other regional partners through the Comprehensive and Progressive Agreement for Trans-Pacific Partnership, or CPTPP. This policy consistency is a huge advantage for the Dong, as it reduces the kind of political risk that plagues the Iraqi dinar. There is no VND-RV speculation community in the same way there is for the dinar, because the story of the Dong is transparent and out in the open. It is a story of gradual, hard-earned progress, not of a hidden, overnight transformation waiting for a political trigger. The potential for investors in Vietnam often lies not in a currency play on the Dong itself, but in investing directly in the Vietnamese stock market, in real estate, or in the businesses that are riding the wave of the country's economic ascent. The Dong is the vessel for that growth, a vessel steered with a deliberate and steady hand by a government that has proven its economic competence over the past 3 decades. In the great IQD versus VND debate, Vietnam presents a case of visible, tangible, and measurable momentum, a stark contrast to the opaque and politically fraught potential of Iraq. Having laid out the foundational stories of both nations, it's time to put their currencies under the microscope for a direct, side-by-side comparison across several key metrics, starting with the most fundamental driver of value, economic structure and diversification. As we've touched on, Iraq's economy is a textbook example of hyperdependence. Over 99% of its export earnings and roughly 90% of government revenue come from the hydrocarbon sector. This creates an economy with zero shock absorbers. A drop in oil prices doesn't just slow growth, it triggers a fiscal crisis. This inherent vulnerability is a massive anchor on the dinar's potential. Vietnam, in stark contrast, has an export basket that reads like an inventory of a global department store. Smartphones, electronics, textiles, footwear, furniture, and agricultural products like coffee and rice. This diversification is a powerful shield. A downturn in global demand for electronics might be offset by stability in textiles or a boom in agricultural exports. This makes the Vietnamese economy, and by extension the Dong, far more resilient to global economic shocks. The next critical area is monetary policy and inflation control. The Central Bank of Iraq, or CBI, has a stated goal of achieving price stability and fostering a stable financial system. It has implemented a de facto peg of the Iraqi dinar to the US dollar, currently around 1,460 IQD to $1 for commercial purposes, though the official rate is slightly different. This peg provides a degree of short-term stability, but it is not without its costs. To maintain the peg, the CBI must hold vast US dollar reserves and must constantly intervene in the market, buying and selling dollars to keep the dinar within its narrow band. This process drains its foreign reserves, and the peg can become a target for speculators if reserves fall too low. Furthermore, Iraq suffers from persistent and often high inflation, driven not by consumer demand but by structural issues: supply chain bottlenecks, corruption that adds a corruption tax to goods, and the government's frequent need to print money to cover budget shortfalls. This erodes the purchasing power of the dinar for ordinary Iraqis, a clear sign of a weak currency. The State Bank of Vietnam, on the other hand, manages the dong with a different toolkit. It employs a managed float, allowing the currency to move within a band that it periodically adjusts. Its primary focus has been on maintaining macroeconomic stability, and it has been largely successful in taming the high inflation that plagued the country in the past. By keeping inflation in the low single digits, the SBOV is preserving the domestic value of the dong, which is a crucial, though less glamorous, form of currency strength. When it comes to the political and regulatory environment, the gap between the two is a chasm. Iraq's political system is fragmented and often dysfunctional, with deep-seated corruption identified by Transparency International as a major issue. Passing laws that would unlock economic potential, such as those governing foreign investment outside the oil sector or resolving territorial disputes between Baghdad and the Kurdistan regional government over oil and revenue sharing, is a Herculean task. This regulatory uncertainty and perceived high risk scare away the very foreign investment, outside of the oil industry, that Iraq desperately needs to diversify its economy. Vietnam, while also facing challenges with corruption, offers a much more predictable and business-friendly environment. Its government actively courts foreign investment, streamlining procedures and offering incentives. The consistency of its Doi Moi policy for over 35 years has built a track record of credibility that Iraq simply cannot match. This favorable environment is why Vietnam consistently ranks as a top destination for FDI in Southeast Asia, while Iraq struggles to attract investment in non-oil sectors. Finally, let's address the elephant in the room: the speculative communities surrounding these currencies. The Iraqi dinar is the undisputed king of currency speculation. A vast online ecosystem of gurus, chat forums, and websites promotes the idea of an imminent revaluation, or RV, where the dinar will skyrocket in value, often by thousands of %, making early investors immensely wealthy. These narratives are typically based on cherry-picked news articles, misinterpreted economic data, or outright fabrications about secret international agreements or the reinstatement of the dinar's pre-war gold standard. It is crucial to understand that this speculation is entirely detached from the on-the-ground economic realities in Iraq. No credible financial institution, such as the International Monetary Fund or the World Bank, supports this revaluation thesis. In fact, they often advise the opposite: that the dinar is likely overvalued at its current pegged rate and that a devaluation might be a more likely, if politically painful, outcome to ease fiscal pressures. The speculation around the Vietnamese Dong is far more muted and is generally tied to its long-term economic growth story, not a mythical overnight revaluation. So, after this deep dive into the realities of the Iraqi dinar and the Vietnamese Dong, where does this leave us as we look toward 2025 and beyond? The conclusion is not about finding a winner, but about understanding two fundamentally different investment propositions, each carrying its own distinct profile of risk and potential reward. Let's project the future trajectories, starting with the Iraqi dinar. The bullish case for the dinar rests on a best-case scenario that involves a series of monumental achievements. It would require a sustained period of high global oil prices, providing the fiscal space for the government to function without crisis. It would demand a level of political unity and maturity that has so far been elusive, resulting in the successful passage of the hydrocarbon law, the resolution of disputes with the Kurdistan region, and a decisive crackdown on corruption that would unlock other sectors of the economy. It would necessitate massive investment in infrastructure, electricity, water, ports, and railways to support a diversified private sector. If, and this is a colossal if, all these stars were to align over the next several years, we could see a strengthening of the Iraqi economy that might allow the Central Bank of Iraq to cautiously and slightly revalue the dinar, perhaps moving from 1,460 to 1,200 or even 1,000 to the US dollar. This would be a significant move of 20 to 30%, not the 10,000% fantasy peddled online. The more probable base case scenario, however, is one of continued muddling through. Political gridlock persists, oil prices fluctuate, corruption remains endemic, and the dinar maintains its precarious peg with the help of the CBI's interventions, with its true value suppressed by the fundamental weaknesses of the economy. A bear case, which is far from improbable, involves a sharp drop in oil prices coinciding with a political crisis, forcing the CBI to abandon the peg and devalue the currency significantly to conserve its foreign reserves, much like we have seen in other oil-dependent nations during times of stress. For the Vietnamese Dong, the future path appears far more linear and predictable. The State Bank of Vietnam has telegraphed its intentions clearly. It will continue its managed float, likely maintaining a policy of a slow, controlled depreciation of the dong against the US dollar to protect the competitiveness of its exports. The goal is not a revaluation but stability and controlled growth. The bullish case for Vietnam is not about the currency itself skyrocketing, but about the nation's GDP continuing its impressive climb, its stock market providing strong returns, and its real estate sector appreciating in value. As Vietnam grows wealthier and its current account surplus remains strong, there may be gradual long-term upward pressure on the dong, but any appreciation will be measured and slow, likely over a decade or more, not in a single dramatic event. The base case scenario is a continuation of the current success story: solid GDP growth, controlled inflation, and a steadily managed dong. The risks, or the bear case, would involve a severe and prolonged global recession that crushes demand for Vietnamese exports, or a geopolitical shock in the South China Sea that disrupts trade, or the country failing to innovate and getting stuck in the middle-income trap. But even in these scenarios, the diversified and resilient nature of the Vietnamese economy provides a buffer that Iraq does not have. Therefore, the final analysis boils down to this: viewing the Iraqi dinar as a speculative investment for a potential revaluation is an extremely high-risk gamble on a perfect and improbable political and economic transformation. You are not investing in an economy, you are betting on a miracle. Viewing the Vietnamese dong, on the other hand, is not really a currency speculation play at all in the short term. It is a proxy for investing in the long-term growth story of a vibrant, dynamic, and rapidly developing nation. The real investment in Vietnam is in its assets and its productive capacity, not in the hope that its currency will moon overnight. For the rational observer, the choice is clear. One path is paved with hope, hype, and immense uncertainty. The other is paved with data, demonstrable progress, and a clear, government-backed commitment to economic development. So, as you leave this video and navigate the vast ocean of information online, I want you to do one thing for yourself. Take this analytical framework we built together and apply it. The next time you see a post or a video promising an imminent dinar RV, ask yourself, has the political gridlock in Baghdad been resolved? Has the oil dependency been broken? Has corruption been eradicated? If the answer is no, then you have your answer about the credibility of that promise. And if you are truly fascinated by the potential of emerging markets, look at the fundamentals, look at the data, and look at the track record. Your financial future deserves a strategy built on bedrock, not on sand. And if this deep dive into the facts behind the headlines has been valuable for you, if it has helped cut through the noise and given you a clearer lens through which to view the world of finance, then you have the power to take this knowledge further. Do not let this be the end of your education. Your next step is crucial. Go down into the comments and let me know which global currency or economic comparison you want us to dissect next. Your curiosity drives this channel. And most importantly, if you found this original research-based analysis useful, then you need to be a part of this community. Hit that subscribe button and ring the notification bell because we are just getting started. We are here to empower you with unbiased, hype-free financial clarity, one deep dive at a time. The world of money is complex, but together we can make it clear. I'll see you in the next video.